filing in. So I'm super grateful that you're all taking the time out today. On behalf of your Baird financial advisor, I'm excited to welcome you to this month's Baird Wealth Strategies webinar. We're joined today by CJ Jessup, manager of the Wealth Planning Associates here at Baird, as he leads an informative discussion that will help you in navigating the Social Security landscape. For those of you unfamiliar with CJ, he joined Baird in 2018 as an intern in the downtown Madison, Wisconsin office. Following graduation, CJ joined Baird's Financial Advisor Foundations program and subsequently accepted an opportunity with the wealth planning team in February of 2020. CJ earned his CFP, Certified Financial Planner designation in the fall of 2020 and earned his Enrolled Agent or EA designation at the end of 2023. CJ has found his passion for creating and monitoring financial plans for all types of clients while leveraging the software tools and expertise available at Baird. So super knowledgeable in the Social Security space. Excited to have you on, CJ. Before I turn the call over to you, just a few housekeeping items to highlight here. First, for optimal viewing, we suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of the screen. All participants are in a listen-only mode, but we'd love to hear from you. We'll be hosting a Q&A session at the end of the call to address as many questions as time permits. You could submit a question by clicking the Q&A icon that should be in the bottom right-hand corner of your screen. Please be sure to address your questions to all panelists. Lastly, this presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. We also have the slides linked to this webinar. You'll find that in the webinar information page, which is linked to the email invitation. So if you go to that email invite, you'll be able to find those slides in the webinar information page. So with that, thank you all for joining us today. CJ, turning the call over to you. The floor is yours.
Thank you, Corbin. Thank you, everybody, like Corbin said, for joining. We've got a lot to cover today. I'm going to hopefully go through a lot. If at any point I'm moving too quickly or you would like for me to elaborate on anything, please submit a question in the chat or a comment in the chat. Throughout the presentation, one of our wealth planners, Sasha Schreiber, he will be responding to Q&As. So he's going to be a bit of a ghost in the machine, but no, that's a real person. That is Sasha. He's a wonderful planner on the team, and he's here to support with questions. Throughout the presentation, I'm also going to do my best to keep it fluid and answer any questions that I think are relevant. But like Corbin said, of course, on the back end, we will do our best to cover any questions that were submitted that I didn't get to. That said, Social Security, the decision for filing is very contextual. It's subjective to your context, what you're looking to do, what you believe in, and the need that you might have for the income. So no answer, no guidance is a one-size-fits-all, and I highly suggest that you reach out to your trusted Baird advisor to help with your context-specific decision. With that, I will begin the presentation, and we'll be walking through the Social Security landscape. Our agenda for today, I will first talk about Social Security's first recipient. She is a legend in my eyes, and she's got quite a bit of lore behind her, and Social Security are certainly Social Security folks, or the folks at the Social Security Administration, write a lot about her, and there's a lot of information out there about her, and I'll talk through her first. I'll go through the basics of Social Security, which include how your benefit is calculated. I will talk through what happens if you're working while receiving benefits, and then talk through some of the tax rules for Social Security benefits. The tax rules are a bit unique, and it's all context dependent, and there is methodology behind the madness there for how federally Social Security benefits are taxed, and I'll discuss that a bit. Talk through when to begin taking benefits. Again, context dependent, but I'll provide some general guidance. Not a one-size-fits-all, of course, but some things to think about. Walk through spousal planning strategies and the future outlook for Social Security, and then options for analyzing your benefits that we have at Baird and those that are available to you on the Social Security Administration website. Ida Mae Fuller, she is the first Social Security recipient. She retired back in November of 1939 and received her first check at the age of 65 in January of 1940. Ms. Fuller had 3 years of taxed earnings. The total taxes that she paid on her earnings for the 3 years that Social Security was implemented and those taxes were implemented was $24.75. In today's dollars, inflation adjusted, that equates to about $542. So she paid in about $542 in today's dollars for or taxes on her earnings to initiate her benefit. The first check that she received was in January of 1940. The amount of that first check, again, monthly check, was $22.54 at the time, or in today's dollars, about $494. So that first check, if we're looking at that 542 and 494, her first check almost equated to or almost equaled what she paid in the taxed earnings or in the Social Security taxes for the 3 years that her earnings were taxed. The total that Ida collected or Ms. Fuller collected throughout her lifetime was about $23,000, $22,888. And today, inflation adjusted, that's about $250,000 or greater than $250,000. The reason I say she's a legend is because that is certainly the most return on any taxed earnings or any paid taxes on Social Security that someone's received. Ms. Fuller lived to about 100 years old, or she did live to 100 years old. So she had a long, healthy life and collected Social Security for a very long time. Now we introduce Ms. Fuller. I'm going to talk about the basics of Social Security. And first up is eligibility. So in order to be able to collect Social Security benefits, the Social Security Administration has defined that someone needs to earn 40 quarters of earnings to be eligible for benefits. For 2024, you earn 1 quarter of earnings for every $1,730 of earnings, so earned wages, tax, Social Security income per year. You can get a max of 4 quarters per year. So effectively, that equates to about 10 years of tax Social Security earnings, as long as you're making at least $1,730, or you multiply that by 4, and it's about $6,800, call it $7,000, that gets you to be eligible for your benefit if you work for 10 years. That doesn't necessarily mean that you have to earn all of that throughout the year. If you earn $4,000 for 2 months of work during the year, you would effectively earn 2 credits for that year. That can all be made in 1 month. That could be made throughout the year. It doesn't make a difference as long as the earnings hit those thresholds. The number of quarters of coverage do not impact eventual benefits. The amount you make and the amount that's actually taxed does. But if you have, I would say 400 quarters of earnings, that'd be 100 years of working. If you have 120 quarters of earnings, that doesn't mean you get necessarily a higher benefit than someone with just 40. It's really dependent on the income that's taxed. That works into calculating your benefit amount. So your benefit is based on earnings over your 35 highest earning years. So what that means is that as your working career continues to go on, certain years might fall off. So for instance, if you worked in high school or in college or in your early career and weren't earning as much as you did towards the latter half of your career, towards the end of your career, those early earnings might be replaced by years of higher earnings. If you only work for 30 years, you would then effectively have 5 years of zero earnings that would work to lower your overall benefit instead of having 5 additional years of income. The maximum creditable earnings this year in 2024 is $168,600. So what that means is any income up to that amount, you'd be paying Social Security tax on. If you earn above that amount, there is no longer Social Security tax. Neither you nor your employer would pay the Social Security tax on any earnings above $168,600. Going backward, that is inflation adjusted. So that number years and years ago would have been significantly smaller, but that continues to increase with general inflation or COLA adjustments, cost of living adjustments. Earnings over that annual maximum do not impact benefits. So what that means, like I said before, is you're not paying taxes on those benefits. Instead, that's earnings that aren't credited to your Social Security benefit. I do recommend and suggest that as you are nearing this decision, and maybe even throughout your working history, that your earnings are reported accurately. Social Security Administration does use your tax return. So they are looking at your federally filed tax return to calculate your benefit, but that doesn't mean it's always perfect. There's certainly times where earnings is misreported. It could be a typo, something like that. So I highly suggest, especially as you're nearing retirement, that your earnings history is as accurate as possible. The maximum benefit beginning this year, again, consider that cost of living adjustments will continue to increase the maximum benefit. The maximum benefit is $3,822 per month for a retiree at full retirement age. That equates to about $45,864 per year. Filing sooner will lower that amount. Filing later than full retirement age will increase that amount. And that's where we get into full retirement age. A worker is eligible for the standard retirement benefit at their full retirement age. When I say standard, I mean your baseline benefit that you are eligible to receive based on the taxes that you paid in to Social Security, which of course are based on your earnings as we went through. This benefit amount is also referred to as a primary insurance amount, or PIA. You might hear someone say, what's your benefit at full retirement age, or what is your PIA? Those two terms, or those two words, I guess, or phrases, they're synonymous with each other. So they mean the same thing. Your full retirement age does change, or has changed in the past, depending on your year of birth. This works into changing life expectancy from 1940. And now that folks are living longer, that retirement age is stepping up, or has stepped up. I think it's fair to fully expect that full retirement age to continue to grow, or continue to increase. Any folks that were born between 1943 and 54 and before, or earlier than 1943, full retirement age is 66. For each year between 1954 and 1960, full retirement age increases by 2 months. Until 1960, for anybody born in 60 or later, full retirement age is 67 amount. So like I said before, that is where you get the standard benefit amount, or what you are truly entitled to, which doesn't adjust for anything that, or any decreased benefit that you would receive for filing early, or increased benefit for filing later. So for most folks at this point, folks that were born in 1954, you're approaching 70 this year, maybe 70 already. So maybe for most folks at that point, that 66 has already been surpassed. I can guarantee that. But folks in the future, you're most likely looking at a full retirement age of 67. Starting benefits before your full retirement age will reduce the benefit that you receive throughout the course of your life permanently. For the first 3 years that you file early, so if you file at 66, 65, 64, somewhere in between, there's a 6.7% annual decrease for up to 3 years early. For every year past that, so when you're getting to 64, 63, 62, and 62 is as soon as you can file, there's a 5% additional annual decrease for more than 3 years early. Or I'm sorry, it's 2 years. So 63 to 62 is when you would get that 5% annual decrease. Recognize that that's prorated monthly. So just because you might file at, let's say, 65 in 6 months, it doesn't mean that you're taking the full 6 2/3% reduction. You would be prorated, and it would be about half that if you file 6 months into the year, 6 months early before you get to the next full age, or 66 in this case. So the charts here that you see, the tables that you see, if your FRA is 66, or if you were born in 54 or before, if you file at age 62, your benefit would be reduced to 75% of your FRA benefit of your PIA. If you wait until, or I'm sorry, I'll get there in a second. If you file at 66, the benefit that you'd receive is 133% of the benefit that you receive at age 62. So that almost doubles for those folks that are 66, your full retirement age is 66. It almost doubles the benefit that you'd get by waiting until your full retirement age. Same thing, or very similar thing, for 67, or folks that FRA is 67, so born in 1960 or later. If you file at 62, which is the earliest you can file, the amount that you receive based on your PIA is 70%. Of course, that means, just like we talked about in the previous chart, if you wait until 67, the benefit amount compared to what you receive at 62 is actually more than double. It's 143% of what your PIA amount is. For starting benefits after full retirement age, there's what they call, or Social Security defines this as, giving a delayed retirement credit, or DRC, of 8% per year plus inflation adjustments. So on this chart here, on these two tables, I'll talk through just the age 67 full retirement age. If you wait until age 70, your increase would be 24%. So you would receive 124% of your PIA amount. Then if we compare that back to 62, it nearly doubles. So that would mean that you're getting a significantly higher benefit amount, which is where the decision-making comes into play. Do you file sooner, get benefits longer, or do you wait and file for a Social Security benefit that's significantly higher, but receive benefits for a shorter amount of time? One thing I want to note here is that the benefit amounts are not compounding. So if we use a quick example, full retirement age of $1,000, I'll try to make this easy. If you wait a year, so instead of filing at 67, if that's what your full retirement age is, and you file at 68, you would get 8% of that 1,000 or $1,080. If you wait 2 years and file at 69, you would get a 16% increase or $1,160. That 8% doesn't backtrack and use the 10th or the 1,080 per month. It still uses that baseline $1,000. So that's not compounding. Inflation adjustments do. So if there's a 3% inflation adjustment on that $1,000, your full retirement age would bump up to 1,030. That 8% would also be inflation adjusted. But what I want to make clear is that that 8% doesn't compound on any other delayed retirement credits that you'd receive. So question is, what if you work while receiving benefits? And this is something that folks like to consider, that some folks will do. Your future Social Security benefits could be increased. The reason for that is because your benefit could be adjusted to account for earnings post-retirement if it is in one of those 35 highest years of earnings. So if you are working and filing past 62, let's say you filed at 63, you're still continuing to work and earning a high amount, your benefit amount could be increased to adjust for the higher earnings that you receive and slotting that higher year of earnings into the 35 years that your benefit would be calculated on prior to this year. This is done automatically after year end. So as I noted previously, the Social Security Administration will take your federally filed tax return and adjust your benefit amount automatically to adjust for the increased earnings. What this also means is that your current Social Security benefits could be reduced. How Social Security looks at the benefit, it's designed to be and is defined to be a supplemental amount of income. It's not defined to be the only source of income, assuming that there are other resources for someone in retirement. So if you are still working and you're pre-full retirement age, the upper limit the upper limit on your benefits would be $22,320 of annual earnings. And when I say that, I'll expand on that a little bit. It means that all of your income up to $22,320 wouldn't affect your Social Security benefits. And that translates to about $1,860 in monthly earnings. And that's how Social Security looks at it. It'll look at it monthly. Then if you make above that $22,320 amount, your benefit is reduced by $1 for every $2 earned over the threshold. So depending on what you're making while you filed for Social Security benefits, if we look at that $3,822 per month max benefit, you wouldn't get that because you filed earlier. Let's assume you filed early at 62. It would be about 70% of that amount. So if we quickly do some math, and don't quote me on this one, I know I'm kind of going off the fly here. Call it about $2,800 or so. If you make more than $2,800 times 12 for that annual amount, let's just make it simple, say 32,000. If you make over 64,000 then, so we're doubling that 32. If you make 64,000, you would receive $0 in Social Security benefits, or I should say 62,000 on top of the 22. So if you make about 86,000 and you filed for benefits, because of that withdrawal or that withholding, that's what Social Security refers to it as, you would receive no benefits. So it is important to consider what your benefit amount actually is, what you would receive if you file early, because you're under full retirement age. That's when this comes into effect, what you might actually receive based on your earnings. Your FRA benefit, or the benefit that you get once you reach full retirement age, where this earnings threshold no longer applies, it will automatically increase to account for the withheld amount. So you're not losing that. It's not lost. It's not gone. But what Social Security will pay you in the current year or in future years because of the reported earnings will decrease. They'll start to withhold that benefit, but they'll give it back to you once you reach your full retirement age. Then we get into how Social Security is taxed. Low-income taxpayers don't pay tax on Social Security benefits. As we look at that chart, for married folks making less than $32,000 of provisional income, and I'll define that in just a moment, you will not pay any tax on Social Security at the federal level, and this is for federal only. If you're single, make less than $25,000 in provisional income, you would pay zero tax. There's this gap or this donut hole between $32,000 and $44,000 for married folks and $25,000 and $34,000 for single folks, that 50% or up to 50% of your Social Security benefits would be taxable. Anything over $44,000 and any income over $34,000 for married and single filers, respectively, would be taxed 85% as ordinary income. One thing to clarify, it does not mean that 85% of your benefit is gone. It just means that 85% of your benefit would be taxed at ordinary income rates. So say you're in the 22% marginal bracket, you would pay 22% federal taxes on 85% of your benefit. So just want to make it clear that you're not losing 85% of your benefit, but you would be paying 22% taxes on 85% of the benefit received if your provisional income is over those amounts. Provisional income is defined as basically everything. All sources of income. So as you can see here, a couple examples are investment income, pensions, IRA, 401k withdrawals, any earned income, wages, that sort of thing. It also adds in tax exempt interest income. So tax exempt interest income, of course, is never taxed. Think income from municipal bonds, maybe as an example. That income is added back to the provisional income to determine how benefits are taxed. And 50% of the Social Security benefit itself is actually considered here too. So for married filers, if you have no other income, depending on what your combined amount is, that might actually trigger federal taxes on the benefit amount that you receive. Again, that's all context dependent. It depends on your situation, but recognize that you likely are paying taxes on a benefit that you're receiving, especially for folks that have filed at the same time, or a couple that have filed at the same time and are both receiving benefits. There's no way to avoid it. It sort of is what it is. And there's actually a calculation or a study that was done by the folks in the Social Security office in 1979 that got to that 50% amount and that 85% amount respectively. What they determined is that through someone's working history, or on average, it's approximate, about 15% of the benefit that someone receives is what they paid in for Social Security taxes. So the way that Social Security has looked at this, and this began in 1984, I believe, is when they started federally taxing benefits. They determined that 85% of the benefits received come from either interest from the Social Security trust fund that's invested in a way to continue to earn and grow that trust fund. That's from interest from the trust fund, but also from other folks paying into Social Security, for the working folks that are paying into Social Security, paying those taxes, and other folks that are now retired that have also paid those taxes. So that's where that 85% comes from. I get that question a lot. Why is it 85%? It's a study done in 1984, and those thresholds have not changed since 1984. So about 10% of folks were actually taxed at the federal level back when this taxation began. That's since increased to about 40% of folks being taxed at the federal level on their benefits because those thresholds haven't grown, but income and benefits have continued to increase since 1984. Continuing on in the taxation of Social Security, some states do not tax Social Security benefits. Some do. The 10 states that tax benefits in some form are listed here. 2 of them just recently decided to not tax benefits. So the folks that are in Missouri, and now I'm not going to remember what any stands for. So apologies there. I think that's Nebraska. So Nebraska and Missouri do not tax federal or state benefits anymore, or do not tax your Social Security benefits at the state level anymore. 31 states do not tax benefits, and 9 states have no income tax at all at the federal level and at the state level, and those states are listed there as well. So know that it's highly likely that you will be taxed at the federal level. Then depending on where you live, that will change and determine whether or not you're taxed at the state level at state-specific laws. When you apply for benefits, it's encouraged, and Social Security encourages you to file up to 4 months before you want them to start. That's the max timeline, or as soon as possible that you can file for your benefits. Generally, what I say is 2 to 3 months or so. If you want to get ahead of it and do 4 months, no problem. Social Security, or the Social Security office, does take about a month or 2 is what their guidance is to file your application and actually pay the benefits or begin to start paying those benefits. Benefits are paid in 1 month arrears. So what that means, and apologies if you could hear that phone, I apologize for that. Benefits are paid 1 month in arrears, which means if you file for benefits to begin in July at age 67, your first check will arrive in August. So you can file as soon as March, which would be 4 months ahead of July 1st, or that specific July 1st start date. First check arrives in August. There are 3 different ways to apply. For folks that are filing for a spousal benefit or as an individual benefit, it's pretty easy to do it online at ssa.gov. For folks that have a more complex case, maybe you're filing as a survivor or a widow or an ex-spouse's benefits, it's encouraged to call in to the Social Security office or in person. During COVID, it was really difficult to get any in-person appointments to be able to go through and file for your benefit. It's now become a lot easier. If you prefer to just make sure that you're totally on the same page with the rep that you're talking to or the agent that you're talking to, I highly suggest that you find your local branch and jump in and make sure that all benefits look good. You're doing the check with them. You fully understand the benefit that you're receiving. If you feel comfortable, I suggest doing it online. Some folks say that the Social Security office or that decision is like the DMV of retirement. I haven't gone through it myself. That's just what I've heard. So maybe it's a lot easier to just do it online and you prefer it that way. When to begin taking benefits. So like I said up front, this is contextually dependent and it's subjective totally on your specific case. When talking through at a high level, there's a few reasons to start early. If you want to leave assets to your heirs, typically what some folks will do is they'll start taking that income early because what that does is it allows their assets and their resources to continue to grow. So they're filling the gap with income to leave other assets on the side to grow. Health considerations are really important. If I knew and we knew exactly when you would pass, I could tell you what the best benefit decision filing or the best time to file for your benefits would be. For those folks that are younger, typically you would want to wait a little bit, or healthier folks would want to wait a little bit because your life expectancy is longer. If your health considerations, your health picture might not look so great or it's not so sunny, you might consider taking benefits while you're younger to maximize the amount of time that you're actually receiving those benefits. Some folks will start spousal benefits sooner because folks rely on that income. So you might have two folks or both spouses filing early, but that also depends on what benefit amount your spouse and you are receiving. Cash flow needs are super important. That's why most folks decide to file early. They need that cash flow to fill the gap between their working years and then relying on other resources and assets to fund their expenses. Other reason, and we'll talk about this later on in the presentation, is you might be concerned about the future of Social Security. As we've seen, and if you've been reading, it's the Wall Street Journal, or you read on the Social Security Administration website, or Kiplinger, or any other sites, there are some concerns about the future of Social Security and its ability to pay out. If that is something that you don't believe will be around in 10 years, I'll get into that. There's a reason why I say 10 years. You might take those benefits sooner and guarantee that you're getting them for at least 10 years. It's up to you, but those are the reasons to start early. That in between, that independence column or that independence section, if you plan to continue working, you might delay until at least full retirement age, because once you hit full retirement age, the income withholding, as we talked about earlier, that income withholding is no longer applicable. You can make as much money as you would like or as much money as you do, and you will not have any benefits withheld. There is also the rate of return on delayed benefits versus what you might get by investing benefits in a portfolio. So that 8% delayed retirement credit, yes, that's an 8% increase in the benefits that you've received, but you're also missing the opportunity cost to potentially take those benefits, file those away if you've got the other assets and resources to be able to let those grow. As we talked about too in the reasons to start early, this also might depend on your life expectancy. There's also reasons to delay. In part, it's because you will maximize your annual benefit. If you wait until age 70, your benefit is maximized permanently. By delaying, you're also maximizing a potential survivor's benefit. So if you're the higher earning spouse, you might consider delaying until age 70, especially if your health concerns are relevant and you might project or you might expect to predecease your spouse. This would maximize then what your spouse would receive on your record, because once you pass, your spouse can either continue to receive their benefit or yours, and they've got that decision. Typically, we say file for the lower earning spouse first, especially if they're the one without the health concerns. Then once higher earning spouse predeceases them or passes, that higher survivor's benefit would go back to the widow or the surviving spouse to take as high of a benefit as possible. Some folks also do this to avoid Medicare. When you file at age or at any age, if you're 65 or older, you're automatically enrolled in Medicare Part A. What that does is it takes away your ability to contribute to a health savings account or an HSA. That's really important to a lot of folks that are continuing to work, and it's unavoidable. So if you file at any point past 65, or you file before 65 and then you hit age 65, you're automatically enrolled in Medicare Part A. One visual that I like to look at, and this is a conversation that I bring up, or at least a thought piece that I bring up, is the health and wealth decision. So hopefully this chart or this graphic is easy enough to read. On the y-axis, we're going from low health to high health. On the x-axis, we're going from low health to high wealth, or low wealth to high wealth. So if you're in that low health, low wealth category, which is the bottom left box, you might consider an early filing. You need the income to fill the gap, and your life expectancy isn't long enough that waiting would be a substantially a nominally better benefit or nominally better filing decision. If you've got high health and low wealth, the question I'd ask you is, do you have the access to resources to gap fill? So you plan on living a long time, but do you have the resources and access to assets that can meet your income needs for that gap period where you haven't filed and you're continuing to delay? If you're in the low health, high wealth category, which is the bottom right box, you might consider who's relying on your income. If you've got low health, high wealth, you don't need the income. As I mentioned before, survivor's benefits might come into play here, where you want to maximize a survivor's benefit for a spouse and delay filing so that if you predecease that spouse, the income isn't totally lost and the surviving spouse is actually going to receive a higher benefit than they might otherwise receive on their own record. If you have high health, high wealth, you might consider delaying because you might not need the income and your health is long enough or you've got a life expectancy that makes it nominally better to wait as long as possible, potentially 70, to file for your benefit and receive a max amount of benefit over the course of your life. This chart here shows the break-even ages for filing at age 62, 67, and 70. So on the chart here, if we look at age 70, which is that bottom left chart, the blue chart or the blue column is if you start, or the total benefits you receive at age 70 if you started at 62, green is 67, and purple is 70. So as we can see, at age 70, if you filed at 62, you'd have received the highest nominal benefit up to that point. At 75 already, so only 5 years later, those benefit amounts start to cross paths or start to get closer to each other. Then at age 80, both filing at age 67 and age 70 have already surpassed the age 62 nominal benefit that you'd receive for those 18 years that you've collected benefits. So if your life expectancy or you expect to live a healthy life past 80, you might consider waiting to file at age 67 or 70 to receive a higher nominal benefit. Then as we continue to go on, or as life expectancy continues to increase, we see that purple chart or that purple column continue to increase past blue, past green, because you're collecting the highest benefit amount possible on your record for a longer period of time. One unique option that folks have once you are past your full retirement age is that you can file retroactively. That's defined by Social Security as saying that you're past full retirement age at any point up until age 70, and you say that you want up to 6 months of unreceived payments. So you're entitled to those benefits or eligible for those benefits, but you haven't collected yet. There's a number of reasons for it, but one conversation that I've had, or this same conversation I've had with a number of folks, is that you might decide to file at 67 and 6 months. And what happens then is you retroactive file until age 67 or back to your full retirement age. You would collect then 6 months in a lump sum of the missed payments that you would otherwise have received. But then your benefit is also back calculated to full retirement age. So by waiting 6 months past or half a year past your full retirement age, you would get a 4% bump for that delayed retirement credit, again, prorated monthly. Your benefit would decrease just a little bit by that 4% back to your full retirement age amount, but then you get a lump sum benefit. That's an option some folks like. Think of it as a Disney fund, if you like, or some other big event or big purchase that you might have, you can get that all at one time. It's not something that folks do very often, but it is an option. For spouses, so spousal planning strategies, there's a lot to consider here. Making your own decision can be easy if you're filing single, if there's nobody else relying on your income. But when there's someone else, so again, a spouse or someone else relying on your income, there's different strategies that you might employ or explore. So one worker can provide benefits to many individuals, of course, themselves, a spouse, a surviving spouse. Minor children can also receive benefits depending on the age of the living spouse and the age of the children. An ex-spouse can receive benefits on your record, a surviving ex-spouse, and also parents. The parents and the minor children, those are both very unique circumstances. So that doesn't come up too often, but recognize that those folks might collect a benefit based on your benefit. For spouses, a spouse's benefit or a spouse is eligible for the larger of the benefit based on their own working history, or 50% of the benefit based on the higher earning spouse's working history. We call this a spousal benefit. Your own benefit is always paid first. So the lower earning spouse's benefit is always paid first, meaning that if you're collecting a spousal benefit, you will get yours first. Then they'll consider that spousal tack on to be paid on top of it. You cannot claim a spousal benefit until the working spouse or that higher earning spouse actually files for their benefit. Meaning if you file at age 67, your spouse wants to do the same thing, but you're a couple years older than them. Say you're 3 years older, you file at 67, your benefit amount is 1,000. Your full retirement age benefit amount is 1,000. Your spouse's is 3,000. You would get that 500. So 50% of 3,000 is 1,500. You have a $500 spousal tack on that you might receive, but you can only receive that once your spouse files. What's really important there is that that will not automatically happen. I don't believe that you can do that online. If you file for spousal right away, you can, but I highly suggest that you call into your local office or make an appointment to make sure that you're beginning to collect those spousal benefits once your spouse files. There is no advantage to taking spousal benefits beyond your own FRA. So we talked about delayed retirement credits, increasing your own benefit amount. If you wait to file past your own full retirement age for a spousal benefit, you don't get those. Delayed retirement credits do not apply. For a surviving spouse is eligible for larger of or the larger of the benefit based on their own work history or 100% of the benefit based on a deceased spouse working history. So what that means is that if a spouse or the higher earning spouse that's predeceased, the living spouse or the survivor, that living spouse, the surviving spouse can receive either what they were entitled to at the time of their death. So if the working spouse was 68, they didn't file and they've got that 8% benefit increase, the surviving spouse is eligible to collect on that amount. Or if they predecease, haven't filed, say at 63, so they haven't filed yet, they're before their full retirement age, they're eligible to collect 100% of the higher earning spouses or the predeceased spouses full retirement age benefit. So there are options there, and that's why the strategy to either file early or file later, it is context dependent, and there are other people that might be relying on that income. So there are options there and things to consider. For surviving benefits, the earliest you can file is age 60, age 50 if you're disabled. And the maximum benefit that you can receive, like I said, is based on your full retirement age. Actually, I think I didn't say that, so I'll correct myself. The maximum benefit available for a survivor's benefit, if you file for one, is at your own full retirement age. So it's all dependent on your own full retirement age, and you get no delayed retirement credits if you file past your own full retirement age. So nothing there or no benefit to file later than age 67, we'll say. There are certain rules. If you file before age 60, so say a spouse predeceases you, you're age 50, you get remarried at age 55, you become ineligible to collect a survivor's benefit based on the spouse that passed. If your second marriage ends, so say you got married at 55 or remarried at 55, that marriage dissolves at age 58. Now you've got the opportunity to file for that survivor benefit again because that second marriage has ended. General tips or the general strategy is that if the survivor is the lower earner, take your own benefit as soon as possible and then switch to the survivor benefit at full retirement age. Again, that's when it's maximized. That allows you to collect, or the survivor to collect, benefits on their own record for 5 years or any number of years, between 62 and 67, or when you might switch, then take that full or the maximized survivor benefit at their own full retirement age. If the survivor is the higher earner, it's just the flip side. Take the survivor benefit early, delay your own benefit potentially up until age 70, potentially collect 8 years of benefits, and then switch to the higher benefit for the rest of your life. Earnings test applies to any pre-FRA benefit, which means that it's not just based on your own benefit, but if you're collecting on another's, that earnings test, that $22,320 that we had talked about a number of slides ago, still applies. This one's always interesting. Benefits for an ex-spouse. The benefit is the same, or it's calculated in the same way for a spouse if you are divorced, as long as the marriage lasted at least 10 years and you've been divorced for at least 2 years. If someone was already receiving benefits at the time of divorce, that 2-year window does not apply. So if you're both age 67, we'll say you're both collecting benefits, you don't have to wait 2 years to apply to get a higher benefit potentially if the working spouse or the higher earning spouse, I should say, was eligible to, or you're eligible to collect on their benefit amount. The person receiving the divorced spouse's benefits must be unmarried, at least before age 60. So if you've remarried, actually, I'll correct myself. If you've remarried, you're no longer to collect an ex-spousal benefit. The working spouse must be eligible to receive benefits. So what can get a little bit tricky here, different from spousal benefits where you have to wait for your spouse to actually file, that's not the case for ex-spousal benefits. The ex-spouse that you might be collecting on just has to attain age 62, and that's when you become eligible to collect on the ex-spouse's record. Now, as you might imagine, it'd be a really difficult call to call up an ex-spouse and say, hey, I really want Social Security benefits. Can you please file? Can't imagine that going well necessarily. It's something that Social Security recognized and said that it doesn't have to happen. As soon as they become eligible or age 62, you're eligible to claim on an ex-spouse's record. Multiple ex-spouses can claim on a single worker. So Tim Steffen, who's the director of advanced planning, he does these calls a lot. He likes to say that depending on the timeline of your marriages, you could have up to 4 ex-spouses claiming on a single worker's benefit. It does not affect, or the benefits paid to an ex-spouse don't affect you or any current spouse or other exes. And divorce spouse benefits stop upon remarriage. I corrected myself earlier. I just want to emphasize that divorced spouses benefits do stop upon remarriage. There is no age 60 consideration or anything like that. It's just at any point in time you get remarried, those benefits will stop. For a surviving ex-spouse, it's the same rules as collecting on an ex-spouse. So married for at least 10 years, you can collect survivor benefits as early as age 60. But for this, you cannot remarry before age 60. So same rules is that surviving spouse, but now we're throwing in the ex-spouse in consideration here too. So if the new marriage ended prior to age 60, then you're eligible for the surviving ex-spouse benefit. If you remarry after age 60, that doesn't prevent a benefit. You're still eligible to collect on the surviving ex-spouse's benefit amount, only if you marry past age 60. So I brought this up earlier, the outlook for Social Security. I'm sure you've heard in the news or read somewhere that the outlook for Social Security is in question a bit right now. Social Security produces what they call a trustees report every year. 2024 should come out, I believe, at the end of Q1. It was produced on March 31st of 2023 for 2022. They put out projections on long range and short range, but I'm going to focus on the long range forecast of how long these benefits might be paid and a bunch of additional information regarding the specifics of benefits. So using intermediate assumptions, which are just the baseline or sort of the average assumptions, the trust fund, the OASDI, which is where benefits are paid from, that fund is expected to cover all the costs or pay benefits amounts in full through 2033, then be fully depleted by 2034 in 2034. That doesn't mean Social Security benefits go away entirely. Past, or let's say in 2034, if this were the case, if there are no changes, the Social Security taxes that the workers are paying, that the working class are paying, would be able to pay or cover about 80% of the promised benefits, eventually falling to 75% as more and more folks are retiring. High cost assumptions, meaning that more folks file sooner, folks are living longer, benefits are being paid more, the fund could be depleted as early as 2031. And under low cost assumptions, meaning folks have short life expectancies and are waiting to file as long as possible, fund could be fully depleted in 2067 and replenished again in 2093, meaning that taxes then that are collected are outweighing or outfunding the benefits that are actually being paid. You can see that chart drop off all the way through 2067. So we can see when that fund is fully depleted, throughout that chart. So that light blue, the high cost, depleted in 2031, the darker blue, 2034, and then the green, we see that fluctuate a bit, but eventually depleting in 2067. So there's some good news, bad news. Life expectancy of the combined OASDI worsened by 1 year from the 2022 report. So this chart might be a little bit hard to read, but in 2011, if we look at that first column, the first year that benefits exceed tax revenues, meaning that the benefits that are paid out are exceeding what are being collected from Social Security taxes, it exceeded what was collected all the way back in 2031. So the first year that benefits exceed tax revenue plus earnings meaning the interest that are being paid on the investments within that trust fund, it was projected to, or the benefits paid were projected to outweigh the revenue plus the earnings in 2023, meaning that back in 2011, the Social Security trustees report said that or projected that the benefit or the trust fund would run out in 2036. Now, as you go across the board here, those numbers tend to shrink, or we're seeing that shrink. So now we're seeing that the trust funds are exhausted or projected to be exhausted from the 2023 trustees report in 2034. We're also seeing in 2023 that the benefits being paid out are in excess of the tax revenues and the earnings within the trust fund. And that's why we're seeing that projection to continue to decrease and be fully depleted in 2034 using those intermediate cost assumptions. So there are some solutions. This is the good news. You might call it good news, but there are a couple changes that would be required over the next couple of years or implemented as soon as possible to make sure that that trust fund does not deplete. One option is increasing the current tax rate by 3.44% up to 15.84%. So that's on the Social Security tax. So that's 6 and change percent that's paid for Social Security, that SSDI tax that comes out of everybody's wages. That would have to increase 3.44%. In total, your employer pays half, you pay half. So they pay 6 and change, or about 6 and a quarter, and you pay 6 and a quarter on all of your wages. You would pay an additional, all workers would pay an additional 1.72% in order to not deplete or avoid depleting that trust fund. Another option is decreasing all benefits by 21.3% today. So you'd receive about 4/5, or folks that have filed would receive 4/5 of their benefit. Can't imagine anybody would be pleased about that. Or reduce benefits for those starting in 2023 by 25%. So that means that anybody who's already receiving benefits would not reduce or would not be reduced, but anybody that's filed 2023 or later would reduce or have a reduced benefit of about 25%, or collect about 3/4 of the benefit that they'd be entitled to. If we wait to make changes, or if Social Security waits to make changes until 2034, the tax rate would have to increase by about 70 basis points, or about 0.7%, up to 16.5%, or we reduce benefits for everybody. And I say we, I mean Social Security. I'm not reducing any benefits. Social Security site or Social Security Administration would reduce benefits by 25% to make sure that the trust fund doesn't fully deplete. Prior board trustee reports, if we take a look at that, again, I'll start in that far left column. 2.15% tax increase in 2011. That was projected to make sure that the trust fund did not deplete throughout the 75-year projection. The immediate percent reduction was projected to be 14% in order to avoid the full depletion. Now, as we go left to right on this chart, in 2023, the immediate payroll tax increase, which is we just highlighted, would have to increase by 3.44%, or reduce benefits by 21%. So what this chart shows is that this is continuing, or the trust fund is continuing to deplete more and more rapidly. There are some additional proposed solutions. So changing taxes, changing benefits amounts are not necessarily the only solutions. But if we were beginning with 2025 payments and we look at the COLA adjustment or the general inflation and take 1% off, that only increases or delays the depletion of the trust fund by 3 years. If we increase FRA from 67 to 69, so as life expectancy is increasing, we would change it from 67 to 69 and increase the first year that someone can file, or the first age, from 62 to 64. That would only increase or avoid depletion of the trust fund by a year. Now, if we invest more heavily in equities, we being Social Security or that trust fund, assuming about a 6% return, it's significantly less than that, because they want consistency in the investments to be able to meet the obligations of paying benefits. There'd be no change in the projected depletion. So even investing more aggressively doesn't do anything to avoid or delay the depletion. If we reduce benefits by 5% for all of those newly eligible for benefits, so anybody who attains 62 in 2024, or those that attain 62 later, there's also no change. A couple of other potential proposed solutions for folks that retire in 2028. It's proposed that you could reduce benefits for couples with income over 120,000 up to a 50% reduction at 360,000. So a graduated reduction in benefits that are received between 120 and 360,000 of income. There would be no impact, no change on the delay of the depletion of the trust fund. Another option is to subject earnings over 250,000 to a 12.4% payroll tax with no credits towards benefits. So it's keeping that percentage, or keeping the taxes that are being paid with no additional benefit to the amount that someone received. That would increase the delay for 23 years. So taxing more but not increasing benefits would delay the depletion for 23 years. Now, of course, that's adding on another $90,000 of income that's being taxed, 23 years of delayed depletion, but that's significantly more taxes that you'd be paying on your income. We could remove the earnings cap in 2023, subjecting all earnings to 12.4% payroll tax, and that would delay the depletion for 26 years. Could also increase the payroll tax from 12.4% to 16.2% in 2024, so a 3.8% increase immediately. That would fully fund the trust fund in perpetuity, or for the next 75 years. I shouldn't say perpetuity, don't quote me on that one, but for the next 75 years. Couple options when analyzing your benefit. First, I highly encourage everybody to request a benefit estimate. You can get that from ssa.gov, and then highlighted here, it's a little bit difficult to see, but that yellow highlight says get a benefit estimate. That's where you can get the benefit estimate. You might also receive that in the mail, but Social Security has recently, in the last couple of years, moved to an online application and in an online resource rather than getting mailers. What seems like as soon as you hit age 60, I've heard a lot about that as you start getting bombarded with the benefit estimates. You'll be required to sign into your government account or create a new login. I've done this myself. Login.gov. So if you see that at the top on that right screenshot there, login.gov is the easiest to use. It's the most recent. It's going to make sure and do its due diligence that you are who you say you are and give you your specific Social Security benefit estimate, which looks like this. So it's different than what it used to look like. It's a bit cleaner, a bit easier to read. You used to see a green and gray and black statement that you would only receive in the mail. Now you can receive that online, and you get a breakdown of everything that you might want to know. So your full retirement age, your benefit amounts at different ages. And one thing I want to call out is that this chart, or the graph that you see, that bar chart, is a little bit deceiving. It assumes that the income you're making right now, you're continuing to make up until those ages. So as we talked about earlier, as income might be higher, that might slot into the top 35 years of earnings. These numbers don't necessarily correlate to the 6 2/3% or 5% or 8%. It'll probably be higher because it's assuming that your income right now is slotting into those 35 years. If your income was zero, it's going to match the prior year. And if the last 2 years were both zero, it assumes you're zero going forward. So if you made $0 in 2023, it'll assume the 2022 amount of income going forward up until the age that you retire per the chart. If the last 2 years were both zero, then Social Security automatically assumes zero going forward. Estimates are all in current dollars, so they're not adjusted for inflation. They're adjusted for decreases in benefits for filing early and delayed retirement credits for filing later. Board of Trustees assumes a 2.4% COLA in the latest report, which is what we talked about before. That's not reflected in this statement or in your statement. Annual earnings history, you can see that here as well. On the left-hand side, it does lump decades together, so you can see the total earnings that were taxed for Social Security. And then depending on your earnings history, that 2001 to 2010 might also be lumped together. This is helpful enough to give you a general idea of what was taxed and what you pay taxes on. But for certain analyses and in certain considerations, making sure your earnings history is correct, on Social Security site, highly suggest getting the full earnings history. There's a different way to do that. The Social Security statement that you see doesn't have every year of earnings. Like I said, it's lumped by decade. You can get that on Social Security's website. There are a few benefit calculators on Social Security's site. The quick calculator is a very rough estimate of what you'd receive. It's going to ask what future income might be. All you have to do is provide your birth date, current earnings, and retirement date. The online calculator is a little bit more, I won't call it efficient, but it's a little bit more accurate. It allows you to add all of your earnings history, and then the windfall elimination provision and government pension offset versions are also available. Windfall elimination provision and government pension offset, or WEP and GPO, apply for those folks that have a uncovered pension, which means that they have a pension that they're receiving from work where they didn't pay Social Security taxes on or on that income. So some folks have worked in a situation like that for 20 years and worked in a job that paid Social Security taxes for another 20 years. What happens is that Social Security recognizes you've got this income elsewhere and will reduce the benefit that they pay to you, a Social Security benefit, because you've got other income. There's also a detailed calculator. You have to download and install it on your computer. It's the most powerful. It can compute almost any type of benefit. Rest assured, there are no viruses. There's nothing that's going to be, your computer won't be hacked or anything like that, but you can download that if you're interested in getting into the nitty gritty. At Baird, our advisors, our team, Baird advisors and teams are, of course, able to provide and have a conversation with you about what your Social Security options look like. This might be tough to see, but there are a few options laid out here, both claiming early at age 62, looking at a maximum lifetime nominal benefit, and strategies in between. This will provide a nominal benefit amount that you would receive over the course of your life if you file and claim on strategy X, Y, Z, or 1, 2, 3, and anything in between. So highly suggest that if you're looking at making a decision or considering it, that you reach out to your advisor to have a conversation and request one of these analyses. And also highly suggest incorporating the decision into your financial plan. Social Security is a major decision. It's one of the biggest decisions that folks make in retirement. I would argue it might be the biggest. And depending on the strategy or the approach that you take, it might impact your chance to meet your retirement goals. For someone filing sooner, you've got a long life expectancy. You might consider delaying as long as possible, maybe until age 70, and that might show you that it actually helps you reach the goals that you have in retirement. The goal of our advisors and the goal of planning is to make sure that you feel confident and comfortable in the decisions that you're making and the financial decisions that you're making to make sure that you can meet expenses later on in life, do the things that you want to do in retirement. Few helpful resources. The SSA site, ssa.gov, you can get general information on Social Security, get your statements, you can actually apply. If you do feel like getting into the nitty gritty, IRS publication 554, tax guide for seniors, it's available at irs.gov. That will walk through how Social Security benefits are taxed, among a few other things. That one, I might encourage if you've got some time and want to dig deeper, not necessarily something that you should feel like you have to go do, though. Your Baird financial advisor can help you walk through that. That's all I wanted to cover today. I realize that was a lot. There's a bunch of Q&A questions in here, and I'm going to do my best to pull out a couple here real quick. Sasha's done a wonderful job of answering most of these in the question or in the Q&A section. I'm going to pull out a couple and talk through those briefly. We've got about 3 minutes left on the call. I don't want to take too much time, so I'm going to answer a couple really quickly. One question: how much does an SSA analysis cost for my Baird advisor? $0. That is something that we offer, our Baird advisors offer as a service to you as a Baird client. So we want to make sure that you're not paying anything for that. It's part of having a comprehensive conversation with you and doing the best we can, provide the most value that we can to you and make you comfortable, confident in that decision. One question regarding reduced Social Security due to earnings over $23,000. Did I hear correctly that it is withheld and you receive the total amount withheld at a later date? That is correct. The calculation is nuanced, finicky might be a fair word too, but what they do, or what Social Security looks at, is your prior year's tax return says, okay, you made over this $23,000 by X amount. Because you made over X amount, we're going to withhold Y from your Social Security benefit. Think of that as kind of just being held on the side. So if it's for me, they're going to say, CJ, you made too much money. We're going to keep this benefit that you would have otherwise received if you hadn't made too much money. We're going to pay you that once you're either full retirement age, which is when that threshold no longer applies, or when you stopped working. And I'm just taking... So one question, this is a good one. I have a pension I haven't taken yet. The company did take Social Security from their paycheck, meaning they did pay Social Security taxes on it. When I begin taking it, when I retire, will that decrease my Social Security? No, that's considered two separate benefits. What that might do, though, is tax your Social Security benefit at a higher amount. So it will look at, or the taxes are considered on all sources of income, that provisional income, or most sources of income. I think it's fair to say pretty much all. It will change very likely how your benefits taxed, but it won't offset or force you to withhold any benefits from Social Security. We will forward the recording of the WebEx. It will be available to you following this call. Corbin, I'm sure you're going to talk about that too. I saw you jump on. A couple questions about that. Question is, if your FRA is 66 and a half, so you're born in 1957, that would mean, and you start taking Social Security at 67, is there an increase in benefits? Yes. So that 8% delayed retirement credit, that is prorated per month. So if your full retirement age is 66 and a half, you wait 6 months. So half a year, you'd get half of that 8% or a 4% increase in benefits. This is a good question. So there's a question about selling a current residence. Will it impact your income? that gets into the weeds a little bit. It's a wonderful question. It's a great question. Depending on the gain on your house or the sale of residence or the sale of property, that may affect the income that you receive or the benefit amount that you received, depending on when that happens. So if it's past your full retirement age, it will change how your Social Security is taxed for that year. But that's a highly specific situation. And that's one where I highly suggest that you reach out to a Baird financial advisor, a trusted advisor, to talk through that situation. There's a number of other questions. If you have follow-up, if I didn't get to them, if Sasha didn't have a chance to get to them, please reach out to your advisor. I'm happy to have a conversation with both you and your advisor to walk through some of the questions that you might have. Done there, Corbin. We're at the top of the hour, passing it back to you. But I want to say thank you to everybody for joining. This is a highly important decision, and I'm glad that we all took the time to, or that you all took the time to join me here and listen to me talk about Social Security. Corbin, all you.
Yep. CJ, thanks so much for your time and your expertise, and appreciate you plugging all that we can do, and advisors can do from a planning standpoint in this space. So I think that's a great next step and something to consider. But just as we're wrapping up here, want to make sure you covered a lot of these, but for those who would like to review today's presentation or share it with a friend, family member, or colleague, it has been recorded and will be available in about a week following today's call through your Baird financial advisor or via bairdwealth.com. For those of you who aren't currently working with a Baird advisor and are interested in having a conversation, you can find an advisor near you on bairdwealth.com via the Find a Financial Advisor button. Actually, just following this call in our post-event survey, you'll find a link to that page that you can copy and paste and go directly to that page to find an advisor. So with that, thank you, everyone. Enjoy the rest of your afternoon, and we'll look forward to seeing you soon. Take care.